The following content has been generated with artificial intelligence under minimal human supervision. The data presented may contain errors or inaccuracies. The opinions expressed in this content do not necessarily reflect the vision, position, or values of DigiAll. We recommend verifying critical information with additional sources before making decisions based on this content.
Welcome to DigiAll Tech News. Today is Wednesday, February 04, 2026. I'm Kylie Brooks, and this is where technology becomes clear and engaging. Nvidia is closing in on a $20 billion investment in OpenAI, even as tensions simmer over chip performance. OpenAI is quietly shopping for alternatives to Nvidia chips, citing dissatisfaction with inference performance. Microsoft Copilot is running into serious problems, with low adoption rates and confusion among enterprise customers. A KKR and Singtel consortium is paying $5.2 billion to take full control of STT-GDC, Southeast Asia's biggest data center deal ever. And Palantir shares jumped nearly 7% yesterday after reporting a 66% surge in US government revenue. Let's start with what looks like a paradox in the AI world. Yesterday, Nvidia CEO Jensen Huang told CNBC that his company would absolutely consider investing in OpenAI's next funding round. Bloomberg News now reports that deal is nearly done. $20 billion from Nvidia to OpenAI. If you're keeping track, that would follow an earlier announcement of up to $100 billion in planned investment. This is a massive financial commitment that would cement Nvidia's position as not just OpenAI's chip supplier, but as a major stakeholder in the company's future. But here's where it gets interesting. At the same time this investment is closing, Reuters is reporting that OpenAI has been unhappy with certain Nvidia chips for months. Specifically, they're dissatisfied with performance on inference tasks. That's the process where AI models like ChatGPT actually respond to your queries. According to 8 sources, OpenAI has been exploring deals with AMD, Cerebras, and Groq since last year, looking for alternatives that could handle 10% of their future inference needs. They're particularly interested in chips with more SRAM, which offers faster performance for certain tasks. Nvidia's response? Jensen Huang insists customers choose Nvidia for inference because they deliver the best performance and total cost of ownership at scale. And Sam Altman posted on X that Nvidia makes, quote, the best AI chips in the world, and OpenAI plans to remain a, quote, gigantic customer. So what we're seeing is a complex relationship. OpenAI needs Nvidia. Nvidia is investing heavily in OpenAI, but OpenAI is also hedging its bets and pushing for better options. It's a fascinating dynamic that shows how even the closest partnerships in tech are being tested by the breakneck pace of AI development. Meanwhile, Microsoft is facing a very different set of challenges with Copilot. The Wall Street Journal reports yesterday that Microsoft's pivotal AI product is running into big problems. As Microsoft's partnership with OpenAI evolves, the company has been positioning Copilot as its own ChatGPT alternative, and that effort is proving tougher than expected. Current and former employees say users are frustrated by confusing brand positioning and interoperability issues. The data is sobering. Only a small proportion of Microsoft Enterprise Suite subscribers are actually using Copilot, and the percentage who prefer it over Google's Gemini or other tools has been declining in recent months. This matters because CEO Satya Nadella has made Copilot central to his vision of transforming Microsoft into an AI-first company. Last week's earnings report already spooked investors with slowing growth in Azure, Microsoft's cloud business, and concerns that the AI business relies too heavily on OpenAI, while Copilot remains unproven. Shares fell nearly 3% Tuesday, as investors worried that AI tools might actually make enterprise subscriptions less necessary. It's a reminder that building great AI technology is only half the battle. Making it work seamlessly for enterprise customers is a completely different challenge. Now, while software companies struggle with AI adoption, the infrastructure side of AI is seeing explosive investment. Today, a consortium led by KKR and Singapore Telecommunications announced they'll pay 6.6 billion Singapore dollars, that's $5.2 billion US dollars, to acquire the remaining 82% stake in STT Global Data Centres from its founding shareholder. This values the Singapore-based data centre operator at an implied enterprise value of 13.8 billion Singapore dollars. This is the largest M&A transaction in Singapore in 4 years and Southeast Asia's biggest data centre deal ever. Why? Surging demand for AI computing and cloud services. The deal will close in early second half of 2026, after which KKR will hold 75% and Singtel 25%. STT GDC operates 2.3 gigawatts of design capacity across 12 markets in Asia-Pacific, the UK, and Europe. The payment will come in 2 equal tranches, funded by 5 billion Singapore dollars in secured debt. What this tells us is that while companies figure out how to monetize AI software, the race for data center capacity, power, and scale is intensifying. Infrastructure is where the real money is flowing right now. Finally, let's talk about Palantir, because their latest earnings show another side of the AI boom: government spending. Yesterday, Palantir's shares jumped 6.9% after reporting that fourth quarter revenue from the US government surged 66% to $570 million. Total sales hit $1.41 billion, beating analyst estimates. The company is forecasting strong growth in 2026, fueled by government contracts. If these gains hold, Palantir could add about $24 billion to its market value. The stock is up 1,700% over the past 3 years. But there's a catch. It's down nearly 17% year to date, and it's trading at a forward PE ratio of about 131. That's a very expensive valuation. CEO Alex Karp defended the company's surveillance tools, highlighting safeguards against government overreach. This comes after scrutiny on firms linked to US immigration and customs enforcement following recent controversies. Morningstar analysts note that growing political support for reindustrialization and strengthening American supply chains creates opportunities for Palantir's software. But Jefferies analysts warn the company must sustain its performance to justify that premium pricing. It's a high-stakes moment for Palantir as it tries to prove that government AI spending will keep growing at this pace. So what's the bigger picture here? We're watching the AI industry mature in real time. Partnerships are under strain, even as billions of dollars change hands. OpenAI and Nvidia are both investing in each other and hedging their bets. Microsoft is learning that enterprise AI adoption is harder than it looks. And while software companies navigate these challenges, infrastructure investors are pouring money into data centers, and governments are spending heavily on AI tools they believe will deliver strategic advantages. It's a moment of both incredible opportunity and significant risk. We'll continue tracking these stories as they develop. Thank you for staying informed with DigiAll Tech News. We'll be back with more updates as they develop.